All right. Can you hear me now, by the way?
Yes.
All right. No, I'm excited for today, and thank you for the intro, Dennis. So my goal here for today really is, to obviously provide value in some things that I think can help you, not only from just to overall helping out your clients, but also helping you be positioned to utilize our products that are going to help them accomplish income, liquidity, and legacy, right? And just to piggyback off of what Dennis said, so my role here, I am the field sales director for all of you. So feel free on case designs, case studies, if you're going through this and maybe this sparks some thought on some clients that you're working on, I'd be more than happy to help you through these. Because today's is going to be a little bit more on the complexity side, right? Because it is incorporating different products that are going to help accomplish clients' wants. And my job is to hopefully simplify it to where it makes sense and we can find some opportunities. And then feel free to jump in with questions. I always encourage that because this is for you guys, and I just want to be here as an additional resource for you. So without further ado, let me go ahead and share my screen over here. And then you'll notice sometimes I will back out of the presentation here just to show maybe some illustrations or go over some case designs, but I'll give you a little bit of an overview here momentarily. All right, can we see the screen?
Yep.
Okay, perfect.
Did you
All
build?
right, so again, yes, I did build this, correct, yes.
Nice.
So, because we don't have anything like set in stone really that we have that's going to really utilize our products that are ultimately going to help us understand where our opportunities are going to lie and what to focus on. So you will see that throughout this presentation I put together, it does have WBC concepts, but I'm not going to specifically say this is all WBC, right? It's just to help us focus, or because I think WBC does a really good job on what we need to focus on certain things, right? So I just wanted to make sure that was a full disclosure. All right, so just a quick overview, what I was planning on. So we have to understand the functions our dollars serve for us. And again, WBC does a good job of helping us set this up because this is what I always like to refer back to. It's income, liquidity, and legacy. And then we'll do a product overview and how each of our products can actually accomplish those three functions, right? And then we'll go over two retiree case examples. One of them will be one that I actually did do when I was on the field, and another one that I did help an agent with. Because I picked these two because they were very, very, there was a lot of products that were involved, but it was all taken care of right there. But it was a simplified way for us to communicate it to the client to ultimately for them to see that those products were going to get them to where they needed to go, right? And then if there's time, which there is quite a bit to go over, we can go over how to set that conversation up, right? What to focus on, how to ask the questions, and how to engage the client. So as all of you know, we have different phases of our financial lives, right? So we have our accumulation phase, and then we have our retirement distribution phase. Now, there's ultimately going to be various products that fit in both of these phases. But to understand, it's important for us to understand that it's one continuous journey, right? When we reach the top of the mountain, the rules change 180 degrees. No longer are we pumping money into our savings. Now we're relying on an income stream. And so we essentially have to be able to position ourselves today that's ultimately going to allow us to come back down that mountain safely, right? But there's things involved that we have to take into consideration, right? We have to have enough liquidity. We have to make sure that they can pay for their everyday expenses, and if they have a family, we have to make sure that if God forbid something were to happen to them, that they're taken care of, right? And so, obviously when we're having conversation with pre-retirees, they're going to be a little bit differently than our retirees. But it's important that we set the foundation in them, that they know there's two phases of our lives. It's pretty self-explanatory. Everyone knows that, you work and then at some point you're going to want to retire, or the majority of people at least want to retire. Some say they want to work till they die, right? There is those people. But you got to make sure that you're asking these questions, right? I can sit here and tell them all day what to do, but if we're not engaging and listening to what's important to them, they feel like they're being sold, and, it could potentially lose someone. So when I'm positioning these types of conversations, right, I always try to get them to realize when we reach the top of this mountain, there's two questions we don't know the answer to. How long are we going to live? And what's the market going to do when we retire? Right? And with those two questions, how do we actually take an income stream off of our saved assets without really have the fear of running out of money, right? And when I ask them that, they're like, I don't know. And it's like, no worries, right? That's what I'm here for, is to make sure we educate you to know what we need to be focused on, and then allow you to make an educated decision on how you want to move forward, right? So now that we've understood those phases, which I'm sure most of the people on this call have a basic understanding of that, right? It's definitely self-explanatory, but now we need to dive into those three functions, right? Well, the first one's income. We all know that. And remember, and actually all three of these functions are going to be for both up the mountain and down the mountain. They'll just have different definitions. Now, obviously income going up the mountain, that's our day-to-day job, right? The income we bring. And then if we're saving for retirement, right? But it's just essentially that paycheck that we're bringing from our occupations. Down the mountain are our saved assets. And our saved assets can actually either be traded or invested. And then there's that third component that, you can take like that distribution from your life policies, right? Get that tax-free income. Now, it's always important that you know how to structure that, but those are essentially, how you can develop those income streams. The second function, our dollar surplus, is liquidity. Now, going up the mountain, I like to think of liquidity as almost like an emergency fund, right? 3 to 6 months worth of living expenses in some sort of liquid savings account. And then also liquidity can be paying for things or saving for things like a house, right? And there's different liquidity tools. You can use investments, or if you structure whole life insurance properly, you can use that as liquidity, right? But I always caution saying that as whole life as liquidity, because there are things you have to take into consideration when actually taking those distributions. But just in essence, going up the mountain, just to know that from a liquidity standpoint, I typically steer towards that emergency fund or saving for things that you're looking to pay for, like house, car, etc. Coming down the mountain, though, or in retirement phase, the definition changes a little bit, right? Because essentially, we want to make sure that we have assets available that we can take from, but we want to be able to take from it without it negatively impacting our income generating assets. And just an example is and what I mean by that is if we have, let's say we're saving everything in investments, we build our dollars as big as possible, right? Well, we all know that from a Monte Carlo standpoint, our safe withdrawal rate, typically your safe withdrawal rate is 3 to 4%, right? You don't want to take more than that, because typically if you take more than that, you run a higher risk of running out of money. And so I always tell people, if we're taking these 3 to 4%, we don't want to have to worry about running out of money. We technically don't have really true liquidity built up inside of our assets, do we? Because that entire amount has to help us generate that income stream. So we just have to make sure we're positioning our assets efficiently so we have that liquidity that when we take from it, it's not going to impact our income that's coming through to us. And that third component is going to be legacy. Now, going up the mountain is going to be income protection until retirement, right? So this is, if you're thinking about it just very general, think of this as like term policies, right? It's going to be the most affordable, and you can pick a day. When you're going to retire, right? Or a general idea, or you at least have control of when you want to retire in a lot of cases, right? So you can use a term policy, because we all know term is going to be the most affordable option to help protect us until we get to that retirement, right? Now, when we come down the mountain, it's more income protection in retirement. So that's where something like a whole life would make sense, because remember, we don't know how long we're going to live, right? And I mean, we don't know what the market's going to do, but just from an actual legacy standpoint, coming down the mountain, you want to be able to essentially overcome that. If you are wanting to leave a legacy, that you're taking that longevity risk, or how long am I going to live into consideration. So that's where whole life might fall in. Any questions on that? Am I talking too fast? Does that make sense? We good? All right.
I think we're good. Do you have in your liquidity piece, do you have a recommendation when somebody says, well, how much should I have liquid? And do you, so how do you answer that?
Come down the mountain or up?
Yeah, and is it different? Is it different for one versus the other?
I think so. So going up the mountain, like I said, I typically try to have only 3 to 6 months worth of living expenses in a savings account, right? That way, if life happens, which we all know life can happen, I have somewhere else to go in that time frame. And then anything that I'm sort of building, I can actually, if you know that the client, is looking to buy a house, car, or they like to spend a lot, right? Well, then maybe I'll open up a non-qualified account and then save into that, because I know if they happen to not take anything from it, well, then I'm still positioning where they can use those dollars for retirement too, right? But I want to make sure the savings account has at least 3 to 6 months worth of liquidity or living expenses built up aside. Does that answer your question on like going up the mountain?
Yep. Yep.
Okay, and then coming down the mountain, it's a little different. So there's a few ways that you can structure that. Now you can use investments, right? Because after 59.5, you can start using your qualified assets as liquidity, and you can have some non-quals. But what I've been doing is honestly using whole life as a function as liquidity, because if you take a loan off of that and pay yourself back, your cash value is right where you left off, and you don't even have to pay yourself back, right?
Yep.
But if I take a loan off of that and I'm using my other investments, or if I use annuities for my income, I know if I take from that, I'm not negatively impacting my income over there, right?
Yep.
And if you're building in a whole life, you're building it efficiently for that income and et cetera. But if you're saving the right way, you're building your liquidity over time anyway. So it's not a set amount, right? It's just it's kind of cash flow. Does that make sense?
Yep.
It's kind of okay. Great question. Anybody else? We good to move on here? All right. Sounds like it. And if anyone does have a question, feel free to just kind of chime in. I'll stop if I hear someone's voice come on.
Or if you want to use the function, you can use that, and I can read it for you. So that's fine. Okay.
Okay. All right. So now one thing I did like about WBC is that they structure it from a two economics power standpoint, because I think this is something that we can all conceptually see and recognize, and it helps understand the risks associated with retirement, right? But the two functions that we essentially, will need, or that we can factor into our overall portfolios. The first one's going to be that fluctuating interest rates or rate of return power. And these are going to be your investment related vehicles. These are great asset accumulators, right? So this helps us generate or build assets from now until retirement. So now with these, it's all about risk versus reward, right? Things that are great about these, they're flexible. So it's flexible savings, and it's flexibility on how you can access your dollars, right? So that's going to be your first power. So the second one is going to be actuarial science, insurance-related vehicles. These ones have steadier earnings rate and can be guaranteed, but they're not as flexible. But just looking at it from a general sense, the first one helps us build assets, right? But it doesn't answer those two questions when we reach the top of that mountain. How long are we going to live, and what's the market going to do? Since we're assuming risk, those can't address that, or at least address it efficiently, because we're assuming all the risk, right? And the second one, actuarial science, it limits us on our build, but it helps us overcome those two questions, right? Insurance vehicles help us be able to not outlive our assets, right? Or have to worry about what the market is. But just you got to have the blend of those two so that we can optimize whatever it is that we're looking to have. So having a specific blend on one or the other, it really just depends on what your client's looking to accomplish, right? And hopefully over these conversations, I can help you drill out, how do we steer one way or the other. All right, so the first function that we're focused on is this income piece, right? And remember, since we don't know how long we're going to live, and I picked this one off of WBC as well, just because it shows us, there's a few things in life that we have to make sure that we're taking into consideration. Now, income from now until retirement age is relatively simple to plan for, right? It's that income coming through our jobs, and we do have a little bit of control on when we do retire, right? Well, then there's other things that we have to take into consideration as well. So there is your life expectancy, which, for a healthy female is right around age 90. But then there's that life potential. There is that potential to outlive our assets, right? And so we have to make sure that we're positioning our income that we essentially aren't going to outlive our assets. So now, looking at the OA product for income, right? So there's a few products that you can utilize when looking at an income portfolio. Now, I'm going to keep it very simple and very general right now and just focus on the product, and then we'll focus on strategy here in a little bit. So the first one's going to be obviously the Oas Investments, right? If you're Series 6, 63, 65, 7 license, you can offer those investments. The second income tool is going to be your SPIAs, your single premium immediate annuities, right? So those are if you have investments or have cash and you want to dump money into this single premium immediate annuity. You can also think of it as a self-made pension, right? I usually call those like a self-made pension because pensions are funded through SPIAs. They give you a guaranteed lifetime income, right? The third one is going to be your DIAs, or your secure income stream, and a DIA is just a deferred income annuity, right? And so what a DIA is that if you're, let's say, age 60, you know you're going to retire at age 65, you can essentially move your dollars into a DIA, and it's going to allow you to receive mortality credits and essentially have a higher income rate at age 65 based on today's rates. There's risks involved with DIAs that I'll touch on here in a little bit, but just know that's the third component. The fourth one is going to be your Freedom Builder and Freedom Builder Plus. So you can use those as income tools as well. And that last component on an income stream is going to be your whole life insurance, because you can structure whole life to help with income as well. But it's important to know that, you know, since there are a lot of different available options from income, that's why it's imperative we understand the client, what they're wanting and what their needs are, to know what products are going to fit best, because you can do a combination of them, and what's going to help us be the most efficient, because you can use that whole life insurance policy income, a portion of it for tax-free income. And the advantage of that, lowering your reportable income so that maybe you don't hit Medicare surcharges, right? So that's just one sort of piece. If you're looking for flexibility, maybe your Oas Investments or your Freedom Builder, we can structure it a certain way, right? So it's that risk versus reward, understanding how much flexibility client wants and what all they know. Because a lot of people don't know, you know, when they're going to retire, and they need that flexibility. So just knowing what's available. So let's start with Oas Investments. So the investment, I like to structure these almost like a pro and con, right? And again, I'm keeping this very general, and investments and these other products, well, there's a place for everything, right? But it's essential that we know, okay, what are the sort of pros, cons to each. So investment pros, rate of return, right? So there's this potential for higher rates of return, you know, time value of money. If we don't touch our dollars, you know, you do have the potential to hit, you know, if you start early, let's say if you give yourself 30 or 40 years to save, it's going to be a lot more beneficial than if you start, you know, in year 10. Or if you only save for 10 years, right? Let's say, or start at 40 later in life, because you're not giving yourself that skyrocket phase later down the road. So the earlier you start saving, the better, but it does give you that higher potential to accumulate through 4, 5, 6, 7, 8% asset accumulators. Another pro, flexible in savings and also withdrawals, right? Now it depends on what product you're using, so I want to be careful in withdrawals, because if you're pre-59.5, you don't want to take from your qualified assets, right? Because then you suffer a penalty. But in general, from an investment standpoint, there's a lot more flexibility, because the client's assuming all the risk, right? So they do have to put higher potential for gain, but they're also, if you're assuming a lot of risk, there are downsides too. You could lose, you know, portions or all of your assets, right? And then also, I jotted a point here that investments can be a great, I guess, add-on or used with other products. So if you're structuring investments right and you have an overall strategy, it can be great with things like, you know, whole life, because whole life can help enhance it, right? Because we have to have an asset accumulator. And remember, since it's so flexible, since you can actually take higher income rates, well, you can use things like other products that have the guarantees to be able to take higher income rates with having less risk of running out of money. Investments cons, if you will, right? And I've touched on a lot of them here, but essentially the big one's going to be, you know, those income rates. Since you are assuming all the risk, yeah, it's great at asset accumulator, but it's not always the greatest on an income rate, because remember, it's not very good at overcoming those two questions. How am I going to live, and what's the market going to do, right? Since there is that potential of running out of money, so it can be risky. None of the dollars are guaranteed, and if you need money, taking from these accounts can result in your lower personal economy. In other words, if you take from, like, if I have $100,000, I need to buy a car. Let's say if I have a 401k, I take a loan of $50,000 or $20,000 or whatever it is. Well, now my interest is accumulating down here. It's no longer accumulating up here, right? So if you actually have to take from it, you can lose your overall personal economy. Since the individual assumes all the risks, limited to how much the individual should take if she should not want to run out of money. So in retirement, essentially what you're looking at is you don't want to try to take more than 3 to 4% based on the Monte Carlo, you know, all the different scenarios that they ran. You're just limited on how much you can take because of risks of running out of money in retirement. All right, so that's investments. Single premium immediate annuities here. So the SPIA pros are going to be really your income rates and overcoming that longevity risks, right? So there's this guaranteed lifetime income, so it's a huge advantage. It overcomes those two questions. You get higher income rates than Monte Carlo safe withdrawal rates. Now, keep in mind, we are in a historical low interest rate environment. But even with the historical low interest rate environment, income rates are still higher than your Monte Carlo safe withdrawal rates. Because even in today, we all know that a safe withdrawal rate is probably closer to about, what, 2.2 to 2.6. Now, if you go and tell a client that, they're probably going to go to an IAR somewhere else, like Charles Schwab or whoever, and they're probably going to say you could probably take 3.5 to 4%, right? So you got to be cautious on saying an actual safe withdrawal rate. So that's where I just want to make sure I point that out. On SPIAs, your income rates are going to be higher than Monte Carlo, and it's guaranteed for the rest of your life. And then also you can use fixed period SPIAs. So what do I mean by that is you can have like a 10-year SPIA, right? So you have a guaranteed payout for 10 years and the income stops after the 10th year, but you can use that to fund things like a 10 pay, right? A whole life select 10 pay. And you don't have to worry about that money ever running out because you're having that just guaranteed. It's contractually guaranteed to pay over that 10-year time span. You're getting a little bit more than what you would have if it just sat in a savings, right? So there is that option as well that we do see. And it can help you delay out Social Security. SPIA cons, really it's going to be the flexibility, right? So once dollars are moved into a SPIA, you're forfeiting liquidity and legacy. Now you can use like joint policies, right, to help cover the both spouses, right? So that if one passes away, the other one still has that same income, but you do reduce your income rate if you do that, right? Because now you're protecting both lives. Single life is going to give you the most amount of income. But again, flexibility, you do forfeit liquidity and legacy once you move into a SPIA. That's why strategy is important. And then this is strictly an income tool. It's definitely not that liquidity and legacy. And then also you can no longer save money into these policies, right? So really just overall in general, just focus on, flexibility is forfeited. All right, so deferred income annuity here. So secured income stream, you maybe see this on I don't know if anyone's ever actually ran one before, but if you hop on, you'll see it'll be income annuity. Then you'll see it's a secure income stream, right? So it's a DIA, so DIA pros. So I'm just going to read this off really quick. So if an individual knows exactly when they want to retire, so let's say if they're age 60 and they know for a fact they want to retire at this day in 5 years, right? This can be a great tool because essentially it allows them to lock in a higher income rate for that future, right? Based on today's rates, right? But it allows them not to worry about, what happens in the market, et cetera. They just know that they want to retire at that age, get a higher potential for a higher income rate later down the road, and then they don't have to worry about it, right? So that is a pro. Now the cons is going to also be that flexibility. And it really has less flexibility than the SPIA because if you're 60 and you want to continue to invest and then still take advantage of having a guaranteed income rate in the future, well, you can invest from now until you're 65 and then roll it over into a SPIA, right? So you would have more flexibility in that regard. In a DIA, no, if you're age 60 and you want to retire at 65, you're rolling those dollars in at age 60, you lose all liquidity and potentially legacy if you don't structure it right. That's why I always encourage to add a fixed 5-year period on there. That way, if you pass away between age 60 to 65, at least the beneficiary would get the premiums that you put in. If you don't put that fixed 5 years, the 5-year option, then if you pass away with the insurance company retains those assets. It stays in that pool. So how you structure this is going to be crucial. But again, for this, you do forfeit liquidity. So it's definitely something to take into consideration when doing this, but it does give you the higher potential for income in the future.
So, Tim,
go ahead.
I thought I had the option to change my date once. So if I said I wanted to on in 5 years, I got one chance to say, hey, not 5 years, let's do it in 8 years. Is that correct?
Yeah, you do. Yeah, you do. I try not to promote just one time, right?
Okay.
But I try not to promote that because if you do one time, sometimes people want to do two, and you definitely can't do two, right? So usually hey, just know the date that you want to work with. Don't worry about changing it because just stick with that date. But yes, you're right. You can change it one time. Correct.
Okay.
And then another thing to take consideration from DIA cons is that, if rates were to increase in the future, let's say you roll the dollars in on today's, lower interest rate environment, and in 5 years, if rates were to spike, well, you locked in that rate, right? But on the flip side, is if rates do decline in the future, well, you got the higher rate. So it's really what happens in the future. You're reliant on what could potentially happen in the future. So there is that, right? Any questions so far? I know I'm talking pretty fast. Is everybody tracking, following? Is this helpful? Good, good. Okay, so now we got the fixed index annuity. This one is a lot of fun, and I like this product a lot. So really, it's our Freedom Builder, but there's two options, and so you're going to see Freedom Builder and Freedom Builder Plus. They're the same exact product. The Plus just adds that income rider, right? So, and income rider is going to be really the bread and butter of this product because of how flexible it is and everything that you can do with this income rider. So the Freedom Builder and Freedom Builder Plus pros. So it's going to be flexibility. So if you think about it, with the SPIA and the DIA, right, you're getting those high income rates and it's guaranteed for the rest of your life, but there's really no flexibility built inside of those once you move it into those products. With a Freedom Builder Plus, however, what you can do is, roll your dollars in, and each year you delay, you get 5% simple interest accumulation on your income base, right? And then you have the ability to annuitize or turn this thing on for income. And when I say annuitize, just think of it as you're basically just move it into a SPIA at that time. So you don't even have to do that, right? You could leave it into the policy, let it continue to grow. Because for a Freedom Builder Plus, there's two values. There's your account value and there's your income and benefit base, right? So your account value is your essentially liquidity and legacy, right? If you never annuitized and you passed away, the client would get the account value. And remember, there's different ways you can fund the account value. That's where you can do monthly average, and there's a participation rate and cap rate inside of those. And then there's also there's your point-to-point option. And also, again, in your point-to-point, there's a participation rate and there is a cap rate. And so they're all tied to the S&P 500. Just think of that as a way to accumulate your dollars, right? And you're limited on how much you can. If you're doing cap, let's say that's 3.25 on your cap and the market does 10%, well, you got 3.25, right? On a participation rate, if the market did 30% and your participation rate is 30%, well, you got 30% of 30%, if that makes sense, right? And so that's why you can get creative on your design, and you can, if you're anticipating a volatile market, that factors into it. If you're expecting a bear or a bull type of S&P 500, that can factor into how you strategize. So learning how those work is going to be crucial. But I'm not going to go too much into that for this conversation. That can be a separate one. But those are the four. And then the fifth one is there is a fixed option, right? So you can actually get a fixed interest rate, and that accrues monthly, as opposed to the other ones accruing on an annual basis or being credited annually, right? So that's how you structure it is going to be critical, especially if you're taking free withdrawals. But for here, just know there's the account value, which is everything I just talked about. That's how it accumulates, guaranteed not to lose anything. But then there's that income benefit base. So let me play a couple of scenarios out for you really quick. If I were to, so let's say I have a 9-year policy, a 9-year fixed index annuity, or a 9-year Freedom Builder Plus, well, you get a 2% bonus, right off the get-go. So if I were to roll 100% or 100,000 into the policy, well, my benefit or income base gets jumped to 102,000. So now that 5% simple interest accumulation is now accumulating on the 102, not the 100,000 anymore. So that's an awesome feature. And remember, 5% simple interest growth in your income benefit base each year for 10 years. So let's say I put my money into this and I'm in year 6 and I want to annuitize in year 7, but I'm in year 6 and I pass away. What happens? What do my beneficiaries get?
Accumulated value.
Bingo. The account value. Yes. Yep. Now let's play this out. I put my money in my Freedom Builder and get my 5% simple interest on my benefit income base. I annuitize in year 7, right? I annuitize the whole thing to get that high income rate guaranteed for life. I pass away in year 8. How much do my beneficiaries get? 0, right? If I do the life only. Because remember, when you annuitize, you're essentially moving it to a SPIA. It's almost like a SPIA option inside of the Freedom Builder. So that's why you got to know, if you annuitize, you forfeit liquidity and you forfeit legacy, right? But it gives you the potential to have a higher income rate, and you can get really creative on how you design this thing and how you delay out, because you can do partial annuitizations too. So again, I bring all that up so we know the basic functionality of Freedom Builder, and we know that it's extremely flexible. And so you can also do future contributions, but only in the 7-year product. We only have 2 options, the 7-year and the 9-year in Freedom Builder. If you're wanting to do future contributions, you'd want to do the 7-year. And then also keep in mind, you can take withdrawals. So you can take 10% surrender-free withdrawals each year off of the account value, right? And so if you were to take the max 10% each year, your income would actually go down, because remember, it's on the previous year's account value. So if I had 100,000, I took 10%, 10,000. Well, naturally, my account value is going to drop the next year, right? Then I get 10% of that lower amount. So just keep that in mind as well. And then also annuitization options, turn it on for income. You can turn on partials, like I mentioned. You can annuitize at any time, and you don't even have to annuitize if you don't want to. So if you want to leave this thing in for liquidity and legacy, there is that component of it as well. So extremely flexible. And then I touched on this already, but another pro is going to be contractually guaranteed to not lose any dollars. And also to add that income rider, it's a very, very cost-effective rider. Only 45 basis points on your account value. That is very competitive when you're looking at the industry. And then also, it's great for protecting assets, right? And there is just a little growth. You always got to keep that in mind. This is a great asset to protect, right? So because remember, it's guaranteed not to lose anything, but you are limited on how much you can grow inside of it if you are using this as an asset accumulator. All right, so the cons, it is, again, limited on that growth. It can have lower income rates than if you were to just do a straight SPIA at that time, right? So, but it does give you that SPIA option. Just it's always important to kind of compare rates, right? And it's not 100% liquid within the surrender charge period. After the surrender charge, 100% liquid. But you just got to keep in mind that if you're doing a 9-year, there is a surrender charge each and every year. You can take 10%, but just make sure you don't promote this thing as 100% liquidity. And then when you do actually annuitize, you do forfeit that death benefit and liquidity, right? So that's Freedom Builder. All right, last but not least, my personal favorite, whole life, right? Now, I know everyone here knows whole life and its pros, so I will try to go a little bit quicker through this one. And we all know it's no risk. You know, cash value and death benefits guaranteed to accumulate, and it can be used as liquidity. You know, taking that loan from the cash value and paying yourself back. Because remember, we're a non-direct recognition company. We take a loan on our policies, it's not going to impact our dividends. So that is crucial for a wealth building perspective. And also, if you are using WBC and you know the strategies, it can help enhance investments. It can help you enhance your investments when you do retire. And then also just keep in mind, it can be a great income tool, right? It can be that tax-free income if it's not a MEC policy, but make sure that you structure this right. And what I mean by that is that when you're taking income and you want to get the most out of it, well, you can get the most out if you do withdrawals, but make sure you don't withdraw past basis. You would want to switch to loans once you hit basis for whatever you put into that policy. That's what I mean by basis. If you take past that amount, right, that's where it would trigger a taxable event. So that's why you withdraw, you hit how much you put into the policy, then you switch to loans. Because if you do that, this thing stays tax-free. And then it can be flexible if you structure it correctly. And how can it be flexible? Anybody? What the rider we can add for it to be flexible? Anyone want to chime in?
Paid up addition.
Oh, go make me. Yeah, there we go. See, Dennis has my back. I love it. Yep, the paid up additions rider. Because remember, if we're like, let's say if we have 10,000 in total annual premium, right, and we have 5,000 going to your paid up additions rider, you can lower it all the way down to 100, that minimum of 120 annually or $10 monthly, right? And so that's premium flexibility, and you're building initial cash. So just know that for the long term, all base policy may give you the most in the long term, but you can add that PUA to not only enhance the values, but also provide that premium flexibility. So just know that that is an option, and definitely a pro with their whole life. Whole life cons, cash value is limited on growth. We all know that, but there is that guaranteed feature, right? It takes a couple of years to build if you're using an all base policy. And then if using all base, just know that your long-term values could potentially grow better. And as I just mentioned this, but you do give up a lot of flexibility if it is all base, right? Because you do have to pay those premiums. Now in the future, when you build cash value, you can maybe offset your premiums let the policy support itself, but it takes a while for you to even be able to build up to that. Okay, income. So that was, we just finished up income. Any questions? Was that helpful seeing that, those sort of comparisons? We good?
Mm-hmm. Yeah.
All right. So now that we just touched on income, now we're going to kind of combine liquidity and legacy here, right? Now I took this off of WBC too because I thought this was an awesome chart. Because as you can see here, so from a short-term perspective, you know, you want your assets, the assets you want need accessible on an immediate basis, right? And so these, and I touched on this on when we were going up the mountain, right? It's going to be those liquid accounts, your checking, savings, or money markets, right? And 3 to 6 months worth of living expenses. Mid to long term, now I'm using, you can use whole life from a liquidity standpoint in a midterm, right? Because remember that cash value accumulation, you can start to use that, take loans, pay yourself back. That can be a very, very useful liquidity tool, but we all know whole life still has a death benefit, the tax-free nature of the death benefit, so that can be a very strong legacy piece as well. And if it's pure legacy, then you can use investments and insurance, right? So OA product for liquidity and legacy, OAS investments, right? That can be a function of your liquidity and whatever's left over when you pass away. That does go back to loved ones. It's important to know, you know, the difference between qualified and non-qualified and how that goes to spouses or even second generations, right? It's important to know how that all works if someone's truly looking to be efficient. Whole life or term, Freedom Builder can be used as a liquidity feature, right? That 10% free withdrawal. And if you pass away, whatever's left over in that account, it will go back to the beneficiary. But then there's this fourth component, asset care, right? And a lot of times people are, I mean, especially in today's world, baby boomers coming into retirement, this is going to be something that's crucial as well. And you can structure this as a legacy play. There is cash value, but I'm never positioning it as a liquidity tool, right? But there is cash value built up if they wanted to walk away. Now, I'm not going to be the asset care or the care solutions expert, but I do know enough to be dangerous. I don't, Dennis, who is your internal, is it Michelle or is it Elaine?
Michelle Prather.
Michelle, okay. So if you have questions on how to build any of the care solutions product, Michelle's going to be your go-to. But again, I'm just touching on this just based on my experience and my limited knowledge that I do know about the care products. All right, so as you can kind of see, there's a lot of products out there and they can accomplish different things. The strategy is ultimately going to be the key. Knowing how the product works, you know, how each of those products will do work is going to be critical because we need to know our clients, we need to know what's important to them, and we need to be able to position those products that are ultimately going to allow them to accomplish what they want. You know, but we have to know, we have to be unbiased when we go in. We have to truly go into and care about the clients and see what they're looking to accomplish and not favor one strategy over the other, and just know that anything can fit in. We just have to know how they fit in, because they're going to have different income, liquidity, and legacy goals. They're going to have different risk tolerances, have different time frames, right? If they're 7 years from retiring, remember, you can structure a 7-year Freedom Builder, right? And because you're not going to hit it as soon as they are ready to retire, the surrender charge is going away. But you can also annuitize it for 7 years, or you can move it into another product, right? After 7 years, just knowing your time frames and knowing those product time frames is going to be critical. And then they're going to have different personal and family goals. And then in my example that I'm going to show you here shortly, it's a unique case because the couple got married late in life and they wanted to keep their finances separately, but just by asking a few questions, it allowed them to say, hey, maybe this one we need to combine, right? But keep everything else separate. But just knowing that families can have different goals is crucial. All right. So my first case study is going to be a retiree. So I'm going to show you a case that closed 6 different total products. So in this one, we used an AUL, and we had like 4 OAS products, and then we had a state life product, right? And the focus on this one was going to be income, liquidity, and long-term care. Legacy was not something that was huge for him, right? So before I jump into all of this, any questions, thoughts? Where are we at? We good? Am I talking too fast? All right. I know I have a little bit of time here, so I'm going to try to get this pulled up, and we'll take it. Can we see?
Yep.
All right. So Income Liquidity LTC. So as you can see, this client right here is, I'll just give you a quick rundown. Oh, very nice. Gotta love it when it logs you out, right? So this client right here, so they're age 59 and they're 56, right? And when, just to give you a quick recap of what they wanted when I reached it out. So the client was essentially, he wanted to be able to access his 401k, right? And he was working as a swim coach, and then COVID hit, and he just wanted to be able to access it, but also he did want to go back to work, right? And so he came to me, he's like, hey, Tim, I want to be able to take dollars out of this, right? And I simply just asked him, if there's, and I can absolutely do that, but I mean, is it important for you to learn, to how to be a little bit more efficient on how your dollars can be accumulating for you so that you're not impacting your long term, or do you want me to just go ahead and take care of this? And he's like, okay, tell me more, right? So it was kind of diving in and understanding what was important to him, because I didn't want him to just go through and take all of those dollars and really negatively impact his financial future, right? And so I apologize that this logged out. I did. Here we go. I'm gonna go to retiree, and this was a retiree case. And so I'm gonna go to agency examples, and then what I'm gonna do, this one is the valued married clients, income liquidity LTC. Here we go. All right. Can you see this, or do you want me to blow it up a little bit more, Dennis?
Yeah, and people can often make it larger on their own Zoom screen. I know I have that ability. I can make it the size I want to on my screen, but that's good. I like it. Okay,
perfect. So yeah, that was a little bit of a rundown of the call, right? Now he did get a new job, right? And so he was bringing in about $3,300 pre-tax per month, right? Even as we were going through our conversations, but I set it up just, saying, hey, I can absolutely take care of this, and I gave a background on what I do. So I said I help people, with income or optimizing, not only their wealth building, but also I do help in the protection sphere, and I do help retirees or people that are approaching retirement efficiently plan from a holistic standpoint, because I'm an investment advisor representative, and I do help on the insurance side. It would be important for you to learn if there's any way that we can be more efficient with your dollars, not only now, but also in the future. And he said, yeah, absolutely. That's great. And then I set the conversation. Hey, I'd love to. So here's what we would want to do. What I found that works best. And I said, what we'll need to do is probably block off 30 minutes to an hour for us to have a conversation. I'm going to highly encourage your spouse, if you're married, to join in, because I always want to make sure that both are on the same page. Does that sound fair? Yeah, absolutely, great. And so as we were kind of going through the conversations, right, I was trying to drill in what was important to them. And how I set this conversation up was essentially, I said, Mr. and Mrs. Client, a lot of the people that I work with that are in a similar position that you both are in, and I try to say exactly what it is, because everyone wants to feel part of a group, right? So I try to make them feel like that's relatable to a group. So I say a lot of the people that I'm working with that are in a similar position that you both are in, they're approaching retirement, right? Maybe, they're looking for the job. They want to make sure they have liquidity. And all these things, but they also want to make sure that their financial future is being set up efficiently. Typically, there's three things that are on their mind, right, or they're worried about. The first thing is they want to be able to maintain a similar lifestyle that they currently are living, right, or what they've been able to generate for themselves all these years. So they want to make sure they maintain that current lifestyle. Second is they want to make sure that they don't run out of money. No one works 30 to 40 years to have to worry about running out of money when they retire. They have to go back to work, right? So that's the second piece. And if I'm able to accomplish the first and second, the third thing is, what are the consequences of needing some form of care, and what are those consequences to my family if I do need some form of care, right? And then I just ask, are any of those things on your mind? And I just let them talk. Because by doing that, I knew I could help in all three. I set it up to where they relate to a group, right? So I planted it sort of in their mind so they have something to focus on. If you would just go, hey, Mr. and Mrs. Client, what do you want? A lot of times people don't know what they want. So that's why you relate them to a group and you say typically what you see, and then you just ask them, is this something that you fall into as well, right? But you're setting that foundation, so now they have something to think about. And then if it's not on their mind, right, any of those three that I just mentioned, if it's not on their mind, then okay, so tell me a little bit more. What is important to you? So you just got to make sure you do drill it out. But by me asking those three with this question for these two clients, I found out a ton, right? I found out that the guy he was a big time Dave Ramsey guy, so he didn't like annuities, right? And then he didn't like whole life, but that's okay. I addressed that. But just so I just give you a picture, it was able to bring all of this out. And then I also found out that this client, the Mrs. Valued client, she actually experienced something with her mother from a long-term care perspective. So she actually lived that. She was taking care of her mom. It was important to her. And I just simply asked her, so okay, so it sounds like it would be important for you to learn how to not have to worry about something like that. And is that accurate in saying that? And she's like, oh yeah, absolutely. Okay, great. So that's absolutely something we're going to figure out, or I'm going to make sure that we take care of. But in order to do that, we have to make sure we have our income, liquidity, and legacy goals fit first, because I got to make sure that you both can live in retirement, right? So that was how that conversation set up. And so when I was actually putting this together, and I don't know if everyone's used WBC or the retiree component to it, it helps me not only look at their assets, but place their assets in a way where it helps me piece together their income. So as you can see, I have working, right? So for him, he did end up finding that job, W-2 income. So he's making about $39,600 per year. This isn't a huge case, but he did do pretty well saving over time. And so as you can see, he wanted to work for about 6 years and retired at age 65. So I factored his income in up until age 65. For her, she had sort of retired and is phasing out a little bit, but she does ref on the side just to make a little additional income, but she has a pretty big pension that really was helpful. And so as you're doing your fact finding, you definitely want to know if they have a pension and all the options inside of it, right? That's going to be a big thing. So as you're asking questions in your fact finder, first thing, I would have them go to SSA.gov and figure out their primary insurance amount or their benefit amount at full retirement age. Because if you don't know yet, or you haven't utilized the tool, you can go to HVS Financial and you can actually run a report, and it'll tell you when's going to be the optimal place that you can take Social Security from, because that's going to be crucial, because it asks you health questions, etc. And if they're not healthy, then maybe you don't want to delay out to 70, right? And also you want to make sure they have enough assets to even be able to delay. In this case, I didn't really delay. I just had them taken at 65, I believe. But so I digress here. So let's go back to work income. You see, she wanted to work about the same amount of time. This is just that repping an extra $10,000 per year. Pension. So her pension is currently on right now. So as you can see, it starts in year one, but it started like last year, and then it goes on forever, right? So that's that single premium immediate annuity component. Here, Social Security. He's going to be the only one that gets Social Security, because how this pension works and what her previous job was, it doesn't allow her to have a Social Security. So for him, what we did was, again, I just delayed out till his retirement age, 65, right? And so I just kind of assumed 30, so he needed to run a report. I ran a report and I kept that separate, but when I first did this, I didn't have that report built out, right? But it was fairly close. All right. So now, when I was looking at all of their assets, I'm going to pull something up here real quick. When I was looking at their assets, and ignore this, I want you to see what their assets are. Here we go. So you see, here's all of their assets. So you see he has 401k, he has an IRA. This is what I ended up moving him to. This is another account. This is her ICMA, right? So you see there's a whole bunch of investments that they had. So I had to figure out, okay, how can I utilize all of these tools that are ultimately going to allow them to optimize whatever it is they're looking to do? And so since they were both, I had to figure out a risk tolerance too. And in this case, they wanted to stay invested because they like liquidity. They didn't like the idea of moving all their dollars to an annuity. Having a higher income rate wasn't exactly the most important thing to them. But I was also encouraged, I said, okay, so tell me a little bit about, annuities in particular, right? Because I know there are various forms, there's various forms of annuities out there. Some, some have a bad rep just because, maybe they have higher fees built up inside of them, but just tell me a little bit about what annuities in particular don't like, so that I can either cross it off, or at least we see if one could potentially fit. And, as I was going through the conversation, I said, well, there's one that may make a little bit of sense, because I see that we're taking on a lot of risk, right? Why not have a portion of your portfolio in this other asset that's, for one, going to be protected. You're not guaranteed not to lose anything. It is limited on the growth, but it's going to help us optimize income in the future. And if you want to take income at different intervals, or if you don't know when you exactly want to retire, you have the flexibility to turn this thing on whenever you want. And so they said, no, that sounds good. So that's where I positioned the Freedom Builder. So I took a portion of her assets and moved it to a Freedom Builder, right? But then I left the other assets available. So I used Morningstar, right? So I ended up rolling four policies into Morningstar, and then that Freedom Builder. But what I did was I was looking at their income, because they said they wanted about a little over 100,000 in total income each year. So I noticed that even by having a lot in the investments, because remember, they wanted the flexibility and they wanted to be able to accumulate. They weren't real concerned on the high income rates, because not everyone's going to be, because they do like to maintain control of their dollars, right? But by moving their dollars into this Freedom Builder and having all these Monte Carlos, because I rolled it over into those investments, I noticed I was still able to get their income to about 117,000, 124. And then I noticed that I still had quite a bit left over. And what I did was I was able to roll dollars from qualified assets. So in this case, I used, I think I put it over here. Yep, here we go. I used, how much was it? It was 105,000. It was actually.
Is this just a house that you built yourself, this page?
Yeah. So you see, the reason why I like it, because you see I have their initial accounts up here.
Yep.
And then for me, how I organize my thoughts is I want to know, okay, where am I rolling it over to? So you see, I moved a portion over to this is actually the asset care. So this was an annuity funding whole life that we did, right? And then what I did was essentially I left zero here, and then there was a portion, the other portion I ended up moving over here. So actually I needed one more line. But yeah, so I try to use these lines so I draw them all out on where I want them to go. And then what I'll do is I'll write.
Do you show this spreadsheet to the client? No.
This is what I go through.
Okay.
So when I'm walking through the client, when I'm walking through, I say, Mr. and Mrs. Client, you said your income goal was to have over 100,000. So here's what I did. I pieced together all your assets. So I made sure that we kept your dollars in your investments, but I had to make sure that we could even get to that income with just investments. Because remember, when all we have are investments, we're relegated to 3 to 4%. And then I told them, I showed them the chart, that Monte Carlo simulations chart. I said, so as you can see, if I take 4%, 30 years down the road, there's about an 85% chance of running out of money. If I take 3%, about a 96% chance. Which are you more comfortable with? And they said 3%. I'm like, okay, so I'm going to plan for a 6% rate of return growth. Are you okay with that? Yeah, absolutely. So I planned for a 6% growth rate and showed them 3% income rate, right? And I said, I'm going to make sure that we can get to your income goals by that. If not, are you open to potentially moving more to, like, let's say something like a tool that's going to give us more income, like some sort of annuity, because annuities are great income tools. They're like, yeah, absolutely. I was like, okay, great. We'll just happen to find out that by doing dollars into investments, because they wanted to take that risk on, and by taking this 3% safe withdrawal rate income, you see this? This is my income right here. And you see, by piecing it all together, by the time to retire, I was able to get to 117. But I also had 105,000 freed up in qualified assets. So what did I do? I took that and rolled it over into that annuity funding whole life. So not only am I able to tackle their income rate or their income, I was able to position their dollars to where she doesn't have to worry about some form of care, right? But
Nice.
again, I show you this so that you know your client, because I could have just moved them all to annuity, showed that, but I probably would have lost the case, right? Yeah, get them a great income, but it's not always about income. It's about understanding how much flexibility they want. Do they want to take risk, right? Do they need control? And then, essentially by understanding everything that they have and what they're looking to accomplish, is piecing it together. I try to free up qualified dollars so I can do annuity funding whole life, but sometimes we can't do that. We have to use all their assets for income, but maybe I get a little higher income and I use that extra to fund an ongoing premium asset care, right? So sometimes you got to know, how can I be a little bit more efficient with income to free up to accomplish things that they want? Because what if they told me that, Tim, yeah, I get the importance of long-term care. Maybe we can talk about that later, but as of right now, it's not the most important thing. Hey, no worries at all. Let's talk about what is the most important thing to you, right? So I didn't want this to be super complex. I didn't want to dive into this, but just know there's a reason why I structured it. And that's why I showed you those products that you have. You have all the products in your tool bag to accomplish anything the client wants. This was one example. The other one that I had pulled for you, but we're out of time, is, I had a freedom builder. I did a whole life policy. I did the covered asset strategy, and then was able to free up enough money to be able to do long-term care. But I did the ongoing premiums because I didn't have enough to be able to do the single pay, right? So know all of your options. But I'll digress. I'll take a step back. That's all I have. I know I'm over time, but was this helpful?
Yeah, what I really like is the case study. So often we probably put you and people in your position in a box and say, oh yeah, he just knows about the product and how to apply it or whatever. This is awesome that you're using the planning software to build the whole case. And just, I want to plug that if you have a case, you've done a good fact finder, go to Tim. He can teach you how to do this, or he can build this case with you and demonstrate meeting the needs, understanding the client, and then coming up with the solution. Like I'm sitting here and saying, okay, I haven't used this portion of WBC software, and we have this available for any of you that aren't even subscribers to the software. That's all right. We can help you build it and what have you. But I'm thinking I have a case that I'm going to bring to you and say, all right, help me illustrate all of this and make sense of it and come up with this. And I'm thinking of others of you on this call that I've talked to, and you've said, okay, I've got this situation, and what do you think about this? And let's use Tim to bring a perspective and planning perspective to this whole thing. So that's really good.
Absolutely, yeah. And I want to know everything about the client, right? I need to know their liquidity needs. I need to know, what's important to them, what they're looking to accomplish. Is it income? Where's their mindset at, right? So this is where you need to go into these types of meetings with the mentality of the person who talks the most loses, because I'm going to ask the most questions humanly possible, right? That's what I'm going to want, and that's what I'm going to need. And it all stems from, I need to know their income, liquidity, legacy goals. That's going to be crucial, right? And understanding the values and what's important to them. So hopefully this was helpful for you, seeing the product, seeing how the functions are dollars served. But yeah, no, I definitely feel free to call me with any case you're working on. I'll help you through it. Absolutely.
All right, Tim. Excellent. Thank you. Thank you, everyone.
Yeah.
We're at time, so we'll sign off and we'll go from there. Be a productive day. Use it wisely.
Thank you.
All right. Thanks, everyone. Take care.
Thank you.